Most people think of a financial network as a list of contacts, investors, bankers, advisors, entrepreneurs, people with money or access to money. Business and wealth-building books, written by those who actually moved through these circles, describe something very different. A powerful financial network is not a directory. It is an ecosystem of trust, incentives, and long-term alignment. And like any ecosystem, it cannot be assembled quickly without collapsing under its own weight. Books that approach networking seriously begin by dismantling a dangerous assumption that access comes before value. In reality, value almost always comes first. Financial celebrities, who eventually found themselves surrounded by influential investors and decision-makers, rarely started by asking for introductions. They started by becoming useful in small, unglamorous ways, often long before money entered the conversation. A financial network, as described in these books, is built on credibility under uncertainty. Money amplifies consequences. When people risk capital, reputation, or endorsement, they do so cautiously. This is why financial relationships evolve slower than social ones. Trust must be proven repeatedly, not declared once. Books emphasize that in finance, consistency beats charisma every time. One of the earliest lessons is that financial networks are formed through proximity to decision-making, not proximity to wealth alone. Being near people who make capital decisions matters more than knowing people who merely possess capital. Financial celebrities positioned themselves where decisions were discussed, even if they had no influence initially. They listened. They learned how risk was evaluated. They understood how incentives shaped behavior. This understanding made their eventual participation credible. Another recurring insight is that powerful financial networks grow from shared standards rather than shared ambition. Many people are ambitious. Few are disciplined. Books show that investors and financial operators gravitate toward those who demonstrate restraint, preparation, and respect for risk. Recklessness repels capital faster than inexperience ever could. Books also stress that financial networking begins with reputation management. Your name must reduce uncertainty for others. This does not require perfection, but it requires predictability. Financial celebrities became known for certain traits. They did not exaggerate. Returns. They disclosed risks. Honestly, they followed through on commitments, and they handled losses without deflection. These behaviors made their presence calming rather than alarming in financial discussions. Another key principle emerges around contribution. In book after book, the strongest financial networks were built by people who contributed information, perspective, or structure before they ever contributed capital. They summarized complex ideas clearly. They connected others thoughtfully. They spotted risks early. Over time, they became valued participants in financial conversations, not petitioners at the edge of them. Financial books also draw a sharp distinction between transactional and relational networking. Transactional networking seeks immediate benefit. Relational networking compounds quietly. In finance, transaction-first behavior is remembered negatively for a long time. Relational behavior is remembered positively, even when no deal occurs. Financial celebrities learn to prioritize relationships over deals, trusting that deals emerge naturally from aligned relationships. Another important theme is selectivity. Powerful financial networks are not large. They are dense. Too many weak ties dilute credibility. Books emphasize that saying no to deals, partnerships, introductions, is often what signals seriousness. Selectivity communicates that your standards are non-negotiable and that capital placed alongside yours will be treated with care. Mentorship appears differently in financial networking than in career networking. Mentors were rarely inspirational figures. They were validators, people whose quiet approval mattered. Financial celebrities earned this validation by demonstrating judgment over time, not by seeking advice constantly. Asking fewer better questions built respect faster than frequent requests ever could. Books also highlight the importance of financial language. Understanding how investors speak about risk-return liquidity, time horizon, and downside protection changes how you are perceived instantly. Financial networks respond to fluency, not hype, not optimism. Fluency. Those who could frame ideas in financial terms were welcomed into deeper conversations. Another recurring lesson is patience with invisibility. Many future financial leaders spent years on the periphery of networks, observing rather than participating. This period was not wasted. It allowed them to absorb norms, understand power dynamics, and avoid early mistakes that permanently damage reputation. Books are clear. Early restraint protects future access. Trust in financial networks is stress-tested, not assumed. How someone behaves when a deal struggles matters more than how they behave when it succeeds. Financial celebrities often earned lifelong allies by acting responsibly in difficult moments, communicating early, sharing. Downside, accepting accountability. These moments defined their reputation far more than profitable outcomes. Books also reveal that financial networks are fragile to ego. Self-promotion, exaggerated confidence, and performative intelligence create distance quickly. The most respected figures spoke carefully, admitted uncertainty, and deferred credit. This humility signaled maturity rather than weakness. Over time, a shift occurred for those who built powerful financial networks. They stopped seeking access and started becoming reference points. Others asked for their opinion. Others wanted alignment. Their role changed from participant to node. Value flowed through them because they had proven how they handled it. As networks matured, maintenance replaced expansion. Quiet check-ins, sharing relevant insights, supporting others without agenda. Financial relationships required care even when no transactions occurred. Books stress that neglect erodes trust faster than conflict ever could. And beneath all these lessons lies the central truth repeated across serious financial literature. A powerful financial network is not built by chasing money, but by becoming someone money can trust to behave well under pressure. Once that threshold is crossed, access follows naturally. And this is where the story begins to narrow. Because when building a financial network is understood not as collecting influential names, but as earning a reputation for judgment, restraint, and alignment, behavior changes fundamentally. Urgency fades, standards rise, contribution precedes asking, and the network grows quietly, compounding through trust and shared experience, revealing its strength only when real decisions must be made, like a structure that only proves its strength when real pressure is applied. And this is where book after book becomes brutally honest about what makes a financial network truly powerful and why so few people ever build one that lasts. In the second half of this journey, serious financial literature converges on a sobering truth. Powerful financial networks are forged more by how you behave when things go wrong than by how impressive you appear when things go right. Profitable deals attract attention. Responsible behavior during loss creates loyalty. Financial celebrities often note that their deepest relationships were not born from their best wins, but from moments when capital was at risk and character was visible. This is why books emphasize stress as the ultimate filter. Anyone can sound intelligent in a bull market. Anyone can promise returns when optimism is high. But when conditions tighten, when assumptions break, when timelines stretch, when losses materialize, the network quietly reshuffles. Those who deflect, blame, hide information, or protect ego are slowly excluded. Those who communicate early, accept accountability, and protect others' downside are remembered. Another hard-earned lesson appears repeatedly: access follows predictability. In finance, uncertainty is expensive. People gravitate toward those whose behavior reduces that uncertainty. Financial celebrities built networks not by predicting markets perfectly, but by behaving consistently. They did not exaggerate upside. They did not downplay risk. They did not change standards to close deals. Over time, this consistency created something more valuable than charm trust under uncertainty. Books also reveal that powerful financial networks are asymmetric in effort. Early on, you give far more than you receive. You share insights. You make introductions. You offer perspective. You help structure decisions without asking for a seat at the table. This phase can last years. Many quit here, assuming they are being overlooked. In reality, they are being evaluated. Finance remembers who contributes without entitlement. Another critical insight is that financial networks are reputation-sensitive, but memory-rich. One careless exaggeration can close doors permanently. One thoughtful act can open doors years later. This long memory explains why books urge restraint in speech and precision in claims. In financial circles, credibility compounds slowly and collapses quickly. As networks mature, selectivity becomes essential. Saying yes to every deal signals insecurity. Saying no with clarity signals judgment. Financial celebrities learned that declining opportunities respectfully often increased their perceived value. It communicated standards. It reassured others that alignment mattered more than activity. Books also emphasize that a powerful financial network eventually stops revolving around transactions and starts revolving around judgment. People seek opinions, not pitches. Alignment replaces persuasion. At this stage, influence becomes quiet. Invitations replace applications. Deals are discussed before they are announced. This is not visibility, it is integration. Another transformation occurs internally. Those who build strong financial networks stop seeing themselves as seekers of capital and start seeing themselves as stewards of it. Responsibility replaces ambition as the dominant motive. Financial celebrities often describe this shift as the moment their network truly solidified, because others sensed the change immediately. Maintenance, too, becomes non-negotiable. Silence erodes trust, even without conflict. Books stress the importance of staying present without agenda, sharing relevant insights, checking in during difficult periods, celebrating others' wins without positioning. These behaviors signal that the relationship exists beyond transactions. And then there is the final quiet realization, repeated across the most honest books: you cannot build a powerful financial network by chasing people with money. You build it by becoming someone whose judgment, restraint, and integrity make others comfortable placing money near you. Once that happens, the network stops being something you pursue and starts being something that surrounds you naturally. This is where the story resolves. A book-driven approach to building a financial network strips away urgency, ego, and performance. It replaces them with patience, contribution, and standards. The result is not a loud circle of contacts, but a dense web of trust that holds when decisions matter most. If this reflection resonated with you, pause and ask yourself one honest question: if capital were placed beside you tomorrow, would your behavior protect it or merely pursue growth? That answer defines the strength of any financial network. Share what stood out to you. And if you want to continue exploring the quiet disciplines that shape lasting financial influence, subscribe and stay connected. Because in finance, the most powerful networks are not built by those who move fastest, but by those who prove again and again that they can be trusted when it counts.